Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Adobe stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 240 billion market cap. They're trading at $5.26 a share, and they have 456 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they generate a ton of free cash flow. It goes from 5.3 billion up to 7.6 billion, their highest ever. Free cash flow is the cash flow that's remaining for you, the investor. So it's how the company pays a dividend or buys back stock. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's really consistent around $5 billion a year. Revenue is the sales for the company, and that goes up a lot. It goes up about 50% from 2020, close to 13 billion, to the trailing 12 months, close to 19 billion. Lots of their revenue comes from subscriptions. We'll look at their income statement in a little bit. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows past year 4, that's 201 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $175 billion. We divide that by 456 million shares. And we get a calculated stock price of $385. They're trading at $5.26, so they're trading at a 37% premium. It's a sell according to the model. Valuation is an art, not a science. If you talk to 10 different people, you'll get 10 different valuations. Because how can you predict the future? It's really hard. I gave them pretty significant growth into the future. The highest free cash flow was 7.6 billion. I gave them 9 billion in 2023, 10 billion in 2024, close to 11 billion in 2025, close to 12 billion in 2026, and the stock still seems overvalued. There are 140 companies in the same industry as Adobe, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx because they're mainly software. A company like Microsoft has a lot of hardware, computers. They also have software as well. Software companies don't need to spend much in CapEx since they're not manufacturing. And software companies tend to have low debt to equity ratios since they don't need much CapEx. Theirs is 0.3, which is better than the median. For every dollar of equity, they have 30 cents of debt. Microsoft also has a great debt to equity ratio because they're a monster. They're the second biggest company in the world. Palantir has the best debt to equity ratio. They don't need much debt because most companies use debt to buy things, warehouses, machinery. A company like Palantir doesn't really have much of that infrastructure. Their special source is the skills and knowledge of their employees. Adobe does not pay a dividend. Oracle and Microsoft pay a dividend. Everybody else does not. Adobe generates lots of free cash flow, 7.6 billion. A lot more than everybody else except the top two. Microsoft is a giant, generating nearly 60 billion of free cash flow. Adobe ranks third in market cap. Of course, Microsoft, the second largest company in the world, behind Apple. I remember when I was in high school tracking stocks, and I think it was Exxon was the largest at 400 billion market cap. And I thought to myself, I wonder if a company will ever hit 1 trillion market cap. Apple is at 3 trillion already. Adobe seems overvalued according to their price multiples. Their price to book PE, price to free cash flow, and price to sales are a lot worse than the median. But their PE, price to free cash flow, and price to sales are better than the average. They generate lots of revenue, 19 billion. Look at Square, 20 billion. And they're much smaller than Adobe. That's why Square has the best price to sales ratio, 1.7, because they have so much revenue relative to their market cap. Price to sales is market cap over revenue, or stock price over revenue per share. Adobe's 5-year annual revenue growth rate is 18%, which is pretty solid, which is the average. Zscaler, 54%. That's the largest on this list. Adobe has done 5 stock splits. The first in 88, a 2-for-1. They've only done 2-for-1s, 93, 99, 2000, and 2005. So if you bought 1 share, say in 1987, in 88 you would have 2 shares. That 1 share would now be 2 shares. In 93, you'd have 4 shares. That 1 share you originally bought in 87 now is 4 shares. In 99, 8 shares. In 2000, 16 shares. In 2005, 32 shares. You see how it multiplies? So if you bought 1 share in 1987, by 2005, you'd have 32 shares. If you put $10,000 into this company 10 years ago, you'd be really happy at $114,000 today. That's a 28% annual return, over a 1,000% total return. They released their financial results last month, and they beat earnings by 3% and revenue by 0.5%. Their revenue expectation was $4.87 billion. They reported $4.89 billion. They also beat earnings and revenue the prior 2 quarters. Let's take a look at their Q3 earnings results. Here's their income statement. So for the most recent quarter, their revenue was $4.9 billion. This is for the 3 months ending 9/1/2023. It's mostly subscriptions, $4.6 billion. I do not pay a subscription because I have their most basic program, just viewing PDF files. But if I wanted to edit files or do some more fun stuff, I might have to pay a subscription. A lot of businesses do that. Some may pay $10 a month or $50 a month depending on the plan. That's the best revenue, subscriptions, because it's recurring. It's like having a gym membership where people pay monthly or private sessions. It's so much more lucrative to have monthly paying members. Because when you have people paying for private sessions, sometimes they cancel, sometimes they don't come consistently. It's so much better to get someone signed up and paying each month, because often they forget to terminate their monthly membership or forget to come. Or if they're paying, it forces them to come more often. That's the idea. Where if they're not forced to pay, they're less likely to come. They also have a small amount of product revenue, $96 million, services, $160 million. For the trailing 9 months, their revenue is up $14.4 billion compared to 2022 at $13 billion. They do have expenses tied to generating the revenue. Their cost of revenue is only $580 million. They have great margins. That's why software companies are so good to invest in. They're really scalable and profitable. A company like Uber doesn't have nearly as good margins, or a company like Tesla, because manufacturing is expensive. Look at these margins. Subscription revenue, $4.6 billion. Only $447 million of expenses. 90% of their revenue is converted to gross profit. Services, you see how bad the margins are. $160 million, expenses of $126 million. Most of their revenue are expenses. But even if they lost money in services, I don't think it matters. You could think of it as a loss leader. Even though they're not losing, they're making a little bit. Because if you get people to sign on to services with the company, then you're more likely to convert those people to the highly profitable subscriptions. Of course, they have lots of operating expenses, R&D $880 million, marketing $1.3 billion, total expenses $2.6 billion, operating income $1.7 billion, up from $1.5 billion. So they're really profitable. Net income $1.4 billion. If you divide that by the shares outstanding, it's $3.07 per share, because they have 456 million shares outstanding. 1.4 billion over 456 million is 307. Let's look at their balance sheet. Current assets of 10.4 billion, current liabilities of 8.3 billion. So their current ratio is above 1. Current ratio is current assets over current liabilities. It's how well you can cover your current debts with your current assets. Current assets are cash, 6.6 billion, and receivables 1.9 billion. They do lots of acquisitions, 12.8 billion of goodwill. Goodwill is the premium you pay when you acquire another company. Total assets 29 billion. Total liabilities 13 billion. So they have lots of equity. Assets minus liabilities equals their equity, 16 billion. That's the value of the company according to the balance sheet. It will be even higher, their equity, if they didn't buy back so much stock. They bought back 27 billion of their own stock. When a company buys back its own stock, they put it onto the balance sheet as treasury stock. Treasury stock is a contra equity account. It brings down your equity balance. But you could see they're so profitable. Retained earnings are 32 billion. Retained earnings is the sum of all their prior net incomes. And they raised $11 billion from selling stock, from selling their business. Let's look at the statement of cash flows. So for the most recent quarter, their net income was 1.4 billion. Then when you add back the non-cash items on the income statement, stock-based compensation is a big one, 440 million. they actually generated $1.9 billion of cash flow, higher than $1.7 billion last year. In their investing section, they bought $91 million of equipment. In their financing section, they bought back $1 billion of stock. This is only for 1 quarter. In the same quarter in 2022, they bought back $1.2 billion. They also reissued some of that treasury stock. So they brought in $124 million from reissuing that treasury stock. I think they do this to manage their taxes better. So that's the end of the video. Let me know what you think of the shortened format. Straight, right to the point. All the info you need, the important stuff. Thanks for watching the video. Leave a like, subscribe, or comment below. Talk to you soon.